Hey, good afternoon, everyone. Marty Mazzora here. It is the 10th of January, 2025. Happy New Year to you all. Today I'm going to touch base quickly on the results of our PWA index. You have that chart in front of you. Then we're going to look through some of my notes, and then we're going to look at market technicals and a few other things here and there to get a feel for general overall conditions for financial markets. So as you can see here on our, call it general conditions or economic index, kind of moving away from the neutral area here of late. Still real close to just that dividing line between conditions being expansionary versus recessionary. In terms of what changed this week, mortgage applications went from neutral to negative. Payrolls, the jobs numbers went from neutral to positive with today's blowout jobs report, we'll call it. Heavy truck sales went from neutral to negative. Inflation break-evens went from neutral to negative. And the sector to S&P 500 ratios went from neutral to negative. Oh, also, I missed the ISM Services Purchasing Manager Survey actually went from neutral to positive. I don't think we'll really get into the weeds of any of those data points today. Just suffice to say that inflation expectations are on the rise. General conditions expectations are pretty solid right here. You'll get some of that from some of the anecdotal data I'm going to share with you here right now. I'm just going to pull over my notes here. Might be a little redundancy depending on how far I go because I did feature some of these charts, or some charts I should say, in the last written blog midweek. So to start with, from this morning, the CPI trajectory looks eerily similar to the late 70s and early 80s. That would be the blue line. The orange line would be the current consumer price index, up to current, I should say. So yeah, eerily similar, I think accurately describes how this looks. If it continues to follow that pattern, then inflation is about to heat up again significantly. I'm not saying that's what's going to happen. Obviously, it's a different period, different dynamics, although very similar Fed reaction function. For a number of reasons, I'm actually thinking, and this is not a consensus view, I assure you, which makes me feel better about it, quite frankly. I'm thinking Eurozone equities could be special during the second half of this year, especially if we actually see more weakness between now and then. BCA is one of our premium research resources, and they have a chart here that says that credit flows are recovering in the euro area. And you can see their credit impulse, along with the forecast based on credit lending standards, et cetera, is moving in the right direction. Small caps will have room to run when the next cycle gets underway. They're getting hit pretty good here of late. We've actually taken on a small allocation to small caps a little earlier than we tend to. A lot of it has to do with what we expect in terms of policy this next year and so forth. Not enough to add significant risk to the portfolio, but it is one of the only areas that look relatively attractive among U.S. equities from a valuation standpoint. Not sure the timing's so great right here. I do think it's going to be special after we get through whatever's left in the current cycle. It's absolutely, unequivocally, and utterly incredible how narrow credit spreads are these days. Hyman Minsky keeps coming to my mind. He's famous for the Minsky moment, where too much complacency ultimately break into something exponentially bad when it hits. And again, the premium that one is receiving for taking the risk in high yield bonds is very, very slim relative to where it's been historically. And that's that spread right in here, high yield versus investment grade. And therefore, I concur with the following. Rising bankruptcies, which as you can see here is the black line, suggest a potential widening of those credit spreads. And the producer of this chart, apparently it was Simon White, says credit spreads cannot remain detached from fundamentals indefinitely. And you can kind of see the history that these two tend to run together. And you can see the stark divergence that's been occurring here of late. Clearly, the folks at the FOMC see the balance of economic and inflation risk leaning to the upside going forward. This is from the minutes. Essentially, that's what it says. And today's jobs number, which was 100,000 better than expected, really kind of, fueled that fire. And, you would think that increasing jobs is a good thing. And as you probably know by now, stocks got utterly smashed today. In fact, we'll get to that, but since I mentioned it, the Dow, it's just after the close as I'm recording this, the Dow took a 680-point hit today, 1.6%. The NASDAQ 100 index was down 1.6%. The S&P was down 1.54%. So just a really, really, bad day. No doubt about it. There's no sugarcoating it. For U.S. equities, clients, the somewhat good news is that our core allocation, if you're just fully allocated to our core mix, was down on the day about 0.5%, depending on the size of your portfolio. 0.53 is what our core shows up at. What worked today was gold, was up nicely, 1.08%. Healthcare stocks actually held up for most of the day, but then they closed down 0.5%. All of our global exposure was down, but ag commodities were up 0.33%, so that helped as well. Energy stocks were up 0.33%. The yen was up 0.3%. That helped because we have an exposure there. The company that we express our bullish view on natural gas was up 1.75%, so that helped as well today. And what else? Silver was up 1%. Gold miners were up just a smidge. Palladium was up nearly 2%. And then, of course, if your portfolio is large enough to hedge this way, our S&P 500 put options had quite the day today, and that'll get more important if indeed this market continues to sell off over the next few months. So all in all, on a relative basis, we captured about 1/3 of the equity market decline. And clients, as I keep reminding you, yours is not an equity market portfolio. Right now, we're just a little over 50% in our core allocation exposed to global equities. We've made some shifts of late that I think exploit global opportunities and even domestic opportunities that we think will present themselves even as what's left in this cycle plays itself out. And we don't know that it's going to play itself out in a very friendly manner. In fact, we suspect that it won't before it's all said and done. But it doesn't mean there aren't pockets of opportunities along the way. What else should I show you here? This is just the FOMC participants, the Fed's expectations for inflation from their minutes, you can see is rising. And just a comment I want to make on, credit card debt and so forth. And I've shown the charts that, over $1 trillion in credit card debt and so forth. And a lot of people are really just pounding on that as being something that's very dire. Well, on a relative basis, it's not really all that dire. And what I say here is for all the ink spilled over record level of consumer debt outstanding, when you compare it to personal income, it's actually at very comfortable levels, and that's what we're showing here. Here we are, pre-pandemic. Credit card debt as a percentage of disposable personal income. You can see where we are now, and total consumer credit as a percentage of disposable personal income. So as long as the economy is doing okay and wages are holding up, this is not a scary number. Of course, if we have a recession and people lose their jobs, well, then that's a whole different conversation, and we are not all that comfortable with recession prospects as we get further into 2025, despite the better than expected jobs number and some other data today. The overall U.S. credit application rejection rates are at the highest level in a decade, I should say. So that contradicts a little bit the sanguineness that I might be expressing here. Delinquency rates are going up, and I do believe that's really concentrated in the bottom 40% of income earners, as I've suggested in the past. That upper 60% is doing virtually all of the heavy lifting. The divergence of late between yields and the data is quite interesting, and that would be data relative to expectations. So this is the economic surprise index rolling over. It was a little better today. It is a component in our own index versus rising treasury yields, right? So you can see there's some pretty close correlation there. You can see the two going in the opposite direction. Rising treasury yields generally denote strong economics, and in this world, sadly strong inflation as well, a falling economic surprise index would typically be consistent with falling yields and pessimism. Also, what's interesting is a divergence between yields and the signal from the metals markets, right? So the copper-gold ratio, which tends to go down when the world is pessimistic because gold outperforms copper, and that's what you can see has been happening here the last few years. All the while, Treasury yields have been rising. So this would suggest, when you look at it purely in an economic context, either yields are going to come down to catch the signal we're getting from the copper-gold ratio, or this is going to come up and copper is going to dramatically outperform gold going forward to catch up to where Treasury yields suggest it should be. It's going to be very interesting, very mixed picture. Now, again, on the positive side, there's nothing about Costco's December results that suggests the consumer is feeling much of any pain. Bespoke is another research provider of ours, Bespoke Investment Group. One of their favorite under-the-radar consumer indicators is comp sales at Costco, which capture a wide swath of customer spending. They reported December comps ex-gas up 9.8% in the U.S., nearly twice as fast as the estimate. Fastest pace since June of 2022, yada, yada. So the action at Costco is not suggesting a great deal of consumer pain, at least not yet. Okay, so again, mixed picture, clearly. We're looking at tons of data every single day, reading too many commentaries probably, very dissenting opinions out there, and just very mixed picture and a time to stay very diversified and we think hedged against something potentially significant, negatively speaking. Okay, so quickly, just daily chart of the S&P. We have been battling right here with this 50-day moving average, which is the green line right there. And you can see it's, it tested it and then came back, and it's basically been resistance at this point. That is a very negative technical sign, frankly. So if it continues to come down here, it's going to have kind of double support at the 200-day moving average and at about 56.60 on the S&P. You break down below that, and it's potentially going to get very ugly for a while. This suggests that odds are not small that that's about to happen. We have quite the long, extended negative divergence on the moving average convergence divergence. It's one of our momentum indicators, and on the relative strength index as well. And this looks a lot like setups in the past. Here we are going into the peak to trough 30%-ish decline in 2022. You can see very similar rising wedge pattern, divergence, negatively speaking, on the momentum indicators and so on. And it works in the other direction at the bottom. Those of you who've been watching me do this for years know how bullish I can get when we have falling wedge patterns and bullish divergences and all the head and shoulders and flag patterns and everything in between. So not a good-looking technical setup. Let's just put it that way. It hasn't been for some time. And ultimately, either this is going to break down and justify these signals, or we're going to break out of these divergences and we're going to be off to sustainable new all-time highs. Base case has to be more pain before we get there, but we're open to all possibilities. The NASDAQ 100 index, one-year daily chart, long rising wedge pattern. On this one, we've been featuring the 20-day moving average. It's been a very important support and resistance line, and you can see it broke down below that with kind of an engulfing bearish candle right here relative to the day or two previous to that. And now below the 50-day moving average with some momentum. Not a good sign for the bulls right here. And, momentum dying here to the downside. Again, long divergences against a rising wedge pattern. That would be a bearish rising wedge pattern. The dollar has been incredible, right? It's continued to follow these flag patterns right up to their target. And this one just a shade below before it sold off right there at 110. Big bearish divergences on the MACD and the RSI. Today's news was very bullish, the dollar, with the jobs number and spiking yields. Our technicals say that the dollar's due for some pain. If it does roll over, that's going to be bullish for global equities, and that would include U.S. equities as well. So we'll see in the coming days how that plays out. I want to feature the Japanese yen as well. We have a position there. We just added to it this morning, actually. It's not a huge position yet, but we are scaling in Short of this low right here, that's about an all-time low, multi-decade low at least, for the Japanese yen relative to the dollar. The Japanese central bank, I've written about this and talked about it internally, is having to come off of decades-long yield curve control. They've been wanting inflation, now they're finally getting it, and I think they're very, very nervous about the yen coming off of these lows, what that may do to the export industry. The world should be nervous because billions upon billions upon billions of dollars worth of investments have been funded by borrowing cheap yen at a very cheap interest rate and then exchanging that for currencies in the areas that you want to invest in, their equities or their fixed income or what have you. So that's called a carry trade. And the yen has been the funding currency, and it's been one of the most popular funding currencies, if not the most, for many, many years. We have had a hiccup or two over the last year, and global equities and global markets in general have paid for it. Some people think that yen carry trade has been unwound. I'm not in that camp. I think there's a lot more of it left. And so if we do ultimately see the Japanese central bank, for example, raise interest rates, which they are expected to do in the coming months, you're probably going to see the yen rally quite hard, right? So we want to own that if and when that happens. Our chart right here, the daily chart, is saying the general setup is there for that to occur. We don't necessarily have a buy signal or much of one. We did kind of break out of this downtrend, but if I want to just do this, I can extend it and say that we're still in it. It's battling with some resistance right here, so it could get worse before it gets better. I will be very, very surprised if our yen position won't turn out to be a very good one over, I'm going to say, the next year to 2 years. 10-year Treasury just exploded higher today on the jobs news, as you might expect. So, why is it that stocks are taking such a big hit when we had good jobs news, right? Well, it's because the stock market has been expecting multiple Fed rate cuts this year. And right now, based on the data at hand, it's just not going to get that. And instead, if we've got an economy that's better than the Fed was expecting, and therefore they're backing off on their rate cut expectations. In fact, they've been ratcheting up, as I showed you a bit ago, their inflation expectations. Well, that's probably not great news for the market. The decline in the stock market in 2022 was really all about inflation fears and monetary tightening and so on. The big washout that we would expect to end the cycle would be significantly declining equity prices, for example, based on recessionary conditions. And now we're not seeing, quite those recessionary conditions. Granted, our index still says odds favor recession over continued expansion in the months to come, but not all the data is consistent with that. The headline data says no, inflation's going to be here, inflation expectations are rising, and if we're going to cut taxes and stimulate on top of that, well, you'd think that it would work so well like it did in 2017. Well, we have inflation now, so that becomes an issue. So again, can I say it one more time? This is the ultimate mixed picture we have here, folks. Gold was very good to us today, I think I mentioned, breaking above that 247-ish here today. If we could sustain that, then we would be, pushing up above 2,500 per ounce of gold, and it would be bullish for our position here. You can see that the technicals are relatively bullish. You can see you had this consolidation zone, but you had the underlying momentum picking up here just a bit. Kind of ambiguous on gold. I get why people would be bullish on the inflation news. Long term, I'm definitely a gold bull. Near term, concerned enough that we have a little bit of protection that we bought underneath our gold position right here. I mentioned the jobs number, 256,000. It was like 150 was the estimate. Unemployment rate dropped from 4.2 to 4.1. Average hourly earnings, et cetera, not a lot of movement there. The quits rate dropped to 1.9. That's actually bearish for the economy. People don't quit their jobs when they're afraid of losing them. Job openings actually, though, did pick up just a little bit. Labor force participation rate stayed about the same. The U6 unemployment, which includes discouraged workers, part-time workers, and so forth, remains at 7.5. And the household survey, which is the phone call to households as opposed to the establishment survey, said that we had 478,000 new jobs created. The purchasing managers' indices have been okay. They, for the vast majority of them, have been above 50. So this aggregates the global purchasing managers' indices. And again, above 50 says that the economy is expanding, and it went from 52.4 to 52.6 this last month. I thought I'd show you commodities. You notice here we were saying that technically it looked like they were due for a bounce. Right now, the Bloomberg Commodity Index is breaking above the downtrend line here. That would be considered a breakout. This is kind of calling for that. A little overbought right here. We're pretty bullish on commodities despite our concerns over the economy. Long-term, next cycle, we are in that commodity super cycle camp. We're not there in a huge way yet because we do think that recession risk is still elevated and commodities generally wouldn't do so well, at least industrial commodities in that scenario. Raw industrials, same kind of thing. I was flagging positive-looking technicals over the past few months, and we're getting a little breakout there as well. So folks, still not a great look in terms of overall general conditions, according to our assessment. If the data is good, folks are going to continue to worry about rising prices and inflation, which is a headwind for stocks. Believe me, at these valuations, things begin to roll over. That's actually going to be bullish for stocks. So it could be that some of this data comes off the boil over the next few months, comes down, the Fed can start talking accommodatively again. You could see a really nice rally in stocks. You want to have some exposure here. But as we come off of the good data, it continues to morph into something serious to the downside, which some of the data suggests that it could. Then we have recession fears, and that's where finally we can work through the end of this current cycle. So folks, I think I'll just impose a hard stop right there and quit rambling. Thank you so much, as always, for watching and listening. Next week, you'll get at least one written post from me and then probably another video at the end of the week. Have a good weekend. Thanks again. Take care. Bye-bye.